everyone, and welcome back. If you've been thinking about getting into investing but feel overwhelmed by all the jargon and complex strategies out there, then you're not alone. But let me tell you, investing is much simpler than it might seem, and you definitely don't need to have everything figured out before you start. In fact, learning as you go is one of the best ways to actually get better at it, as long as you avoid some common beginner mistakes that can cost you big time. Now, before we start, a huge disclaimer that I'm not a financial advisor or consultant, so make sure to do your own research and due diligence before you make any investment decision. So with that, today I'm breaking down 9 costly mistakes that beginners often make, and more importantly, how you can avoid them to make most of your investment journey. So let's start. One of the biggest mistakes I've made myself is waiting too long to start and telling yourself, I'll invest later when I have more money, thinking that when you have more money, you'll get bigger and quicker returns. But that's the fallacy. In fact, it's exactly the opposite. The way that you'll grow your money is by starting small. The earlier you start, the better, because time is your biggest friend when it comes to building wealth. The famous investor Ray Dalio bought his first stock at age 12. He invested his $300 savings that he earned from golf caddying, planting the seeds for Dalio's lifelong interest in investing, and eventually to a net worth of $15 billion. So here's the truth. You don't need a ton of money to begin. Even small amounts, when invested early, can grow exponentially thanks to compound interest. For example, if you invest $200 a month starting at age 25, you'll have way more money by the time you retire at 65, let's say, than someone who waits until 40 and then invests $500 per month. Why? Because the earlier you start, the more time your money has to grow. And here's the thing, you don't need to understand everything about investing right away. Start small, learn along the way, and as your investments grow, you'll naturally get more committed to learning. Just do me a favor and please don't wait until you've got it all figured out, because you'll learn more from smaller mistakes earlier than from bigger ones later. And the next mistake that is huge and can cost you hundreds, even thousands of dollars over the years is not using your TFSA and RRSP, and instead just investing in a regular, non-registered account. Now, in case you're new to all of this, let me explain. Registered accounts like the TFSA and RSP are tax advantage accounts, meaning that when you use them properly, you can save a lot of money on taxes. What these two accounts have in common is that you don't pay any capital gains on the investments made in these accounts. So let's just say that you bought 100 Nvidia stocks at $52, and after only a few months, the stock price shoots up to $115, bringing your stock's worth to $11,150. If you held all your shares in a non-registered account, you'd be taxed on your $6,300 capital gains and any dividends that you earn, which can really reduce your returns over time. However, if you keep your shares in a TFSA or RSP, you won't pay any taxes on your capital gains. That's the gist of it, and there are more nuances to it, so if you want to learn more, check out the videos here in my playlist. Now, in case you're thinking that setting up a TFSA or RSP must be complicated, it's absolutely not. In fact, you can open these and many other registered accounts within just minutes on online investment platforms like Wealthsimple. I got a tutorial up here that walks you through setting up your account, and you can even use my referral code to get a $25 bonus when you sign up, and all you need to do is just fund your account with $1. Note that I'll also receive a small commission when you do that. Now, the next mistake that many beginners make is quite insidious, and I plead you not to make this mistake, which is paying high investment fees. This is usually the case when you let an investment firm manage your investments, and in exchange for their services, you pay them a fee of 2% or more. Just 2%, that's not much, right? Unfortunately, 2% each year can add up to a lot. Let's say you invest $1,000 per month for 30 years. If you're paying a 2% management fee, over the course of those 30 years, you could lose tens of thousands of dollars in fees. A better option? Manage your investments yourself by using a self-directed investing option. And yes, almost all financial institutions nowadays, well, I'm not sure about the traditional ones, let you do this. And then simply invest in low-cost ETFs like the VFV, which tracks the performance of the S&P 500. And there are also many more great ETFs that have much lower management fees, often under 0.5%. That way, you'll keep much more of your returns, and that can make a huge difference in the long run. Now, the next mistake is one that so-called advanced investors also do, which is trying to stock pick. And I get it, it's so tempting to just pick stocks and ride the hype, chasing trends and buying the next big thing, anything that's currently being highlighted in the news. And I'm not saying here that it's always the wrong choice. Of course you can make a lot of money picking stocks. Sometimes, at least. I'm just saying that you gotta invest in something for the right reasons, not just because everyone else is buying it. Even professional investors like Warren Buffett struggle to consistently beat the market with stock picking. And this is common sense. No one can pick stocks with 100% accuracy. The market is just too unpredictable, and most people, myself included, just don't have the time or resources to thoroughly analyze and do deep dives on companies. When you invest in something that you don't understand, it's so easy to end up buying high and selling low and losing big time. And one of the golden rules of investing, after all, is to only invest in what you understand. But don't worry, I'm not saying that you shouldn't buy any individual stocks, never ever. I myself do buy some individual stocks, although they comprise a small percentage of my portfolio. The key is just to understand the risk that you're taking and manage your risk by also investing in ETFs that are diversified across hundreds or even thousands of companies, so you're not relying on the success of one single stock. You can check out some of my top ETFs up here. Now, the next mistake is really easy to make when you become too tunnel vision, which is not diversifying enough. And this is a big one, especially for those of us living in Canada. It's easy to think that putting all your money in Canadian stocks is a good idea. After all, we're living here. But the reality is that the Canadian stock market represents less than 3% of the global market. And within that 3%, the market is very heavily weighted in sectors like banks and energy. So what happens if one of those sectors hits a rough patch? You'll likely feel it, which is why diversification is very important. You should be looking beyond just Canadian stocks. Consider investing in ETFs like the VOO or the VFV, the XEQT, or XAW to spread your investments across the world. But diversification isn't just about stocks. It's also about spreading your risk across different asset classes, like bonds, gold, and different sectors. There's even one asset that many beginners overlook, and that brings me to the next mistake, which is ignoring Bitcoin as a long-term asset. And this might surprise you because you might think that Bitcoin is either a fad or just for more advanced investors. Now, before you click off thinking that Bitcoin is just another dying trend, hear me out. Bitcoin has been one of the best performing, if not the best performing asset of the past decade, outperforming the S&P 500 and even gold. Even big investment firms like Fidelity, BlackRock, like them or not, now recommend that investors put a small percentage of their portfolio, around 1 to 5%, in Bitcoin. So why consider Bitcoin? One way to describe Bitcoin is that it's a decentralized asset with a limited supply of only 21 million coins, which means it has the potential to grow exponentially as more people start adopting it and as inflation risks increases in the traditional financial system. And I've got a full video breaking down what I think about Bitcoin and whether it's too late to buy Bitcoin now. And in case you want to get started with a small amount of Bitcoin fractions, who here has the money to buy a whole Bitcoin now? Not me. It's easy to buy any amounts of Bitcoin on investment platforms, including on Wealthsimple, if you prefer to have all of your investments on one platform. And there's also a guide to that up here. Alternatively, if you're up to opening a separate account on a different exchange, you can get super low transaction fees by buying your Bitcoin on NDAX, a Canadian exchange. Here, you can also get a $10 bonus if you sign up using my link in the descriptions down below. Now, the next mistake I see many people making, not just beginners, is trying to time the market, thinking, I'll wait for the dip to buy. Trying to time the market is actually a rookie mistake. You think you'll wait for a market dip, but what if you miss it? You could end up waiting forever or getting in at the wrong time. For example, let's say you were waiting for the market to dip even further in 2020 before buying. If you've waited too long, you would have missed one of the fastest market recoveries in history after the COVID crash. So instead, try dollar cost averaging. DCA means investing regularly regardless of market conditions. When prices are low, you can buy more shares. When prices are high, you buy fewer. This strategy smooths out market fluctuations and helps you avoid trying to time the market. The next mistake has to do with human psychology as well, which is panic selling in a down market. And this is where many beginners lose out. Yes, it is stressful when the market drops, but selling your investments means that you miss the chance to make money once the market bounces back, which, as history has repeatedly shown, usually happens. Think back again to 2020 when the market crashed. A lot of investors sold in fear only to miss one of the quickest rebounds in stock market history. It's a reminder that holding on to your investments and riding out the dips is often the best approach. But of course, there are cases when selling can be a good idea. That's if a stock's fundamentals, meaning the company's financial health, like its earnings, revenue, and overall business model, are changing for the worse, and it's just no longer a good fit for your portfolio. Now, the next thing is something so critical. It's something beginners often forget and can leave you in a really tough spot, and that's investing without having an emergency fund. Never rely on having to sell your investments to pay for rent or other unforeseen expenses. This is what could happen if you don't have an emergency fund and your investments are down. You might be forced to sell them at a loss. Do the following instead. Have 3 to 6 months of expenses saved in cash, or much better, a high interest savings account, which means that you won't need to dip into your investments when life throws you a curveball. Your investments should be for long-term growth and not for covering short-term expenses. Now, avoiding these 9 mistakes will put you on the path to financial success, and I promise your future self will thank you. Now, if this video has encouraged you to start investing, but you need a little extra help, I've got a tutorial here on how you can get set up on Wealthsimple and start investing today. Thanks for watching, guys, and I'll see you in the next one.